Hello, everybody. This is Eric Hale with another episode of The Everyday Trader. We keep trying to figure out how to deliver content you want. We got some feedback about the last one. You didn't like it, but different things come up, and we try to present what we think would be useful to you, thinking about everyday traders who are out there, not policy experts or insiders or institutional traders. I mean, this is for retail traders who are trying to understand markets. And there's a lot of things that are moving on. Greg's here with me today. Hey, Greg, how are you?
Hey, good. Before we get into the markets and this conference you went to, I have to make my prediction already because it's the off season now, and the only sport I care about is baseball, and so I'm predicting my next year's World Series champ by which hat I'm wearing. I'm calling the Orioles.
The Orioles.
Yeah, the Orioles are good. They're young. They're anyway. I know you guys don't care about my opinions on
Uh,
baseball, but
for a second, I thought you were going to get ahead and do our end of the year, predictions, and we do a thing for people at the options animal community where we talk about what we think are going to be the big themes over the next year, and we make predictions and stocks to watch. I think you're doing pretty well.
I
I
have
think
Micron.
you picked
So
Micron. It's up like
Micron is one
136.
of my stocks to watch. So I could do nothing else and
Yeah.
just I'd be fine.
Yeah. Your pick. Yeah. I think you're up the most. Like, I think Micron was up like 136% or something crazy from last year.
Insanely big move this year on Micron, that is for sure.
Yeah. That's just for fun because we can make money in any direction, but that's not the prediction you're talking about. You're talking
No,
about
I'm
sports.
yeah, I'm it's off season. It's pitchers and catchers don't report until March. So
Of course, the
actually
Bears, they're actually good this year. They couldn't beat the Packers yesterday, but oh wow. You didn't happen to watch that. It was a fun game.
I didn't actually watch.
It was
Like I said,
first half was boring. Second half
my
was really fun.
professional sports, I've had to select which one I stuck with, and I'm following base. I have watched college football. College football's been interesting, but anyway. You guys again probably really don't care about our
Yeah,
opinion on
Idaho needs a
sports.
Idaho needs a professional team. So you,
That's not going to happen. Here's why. Idaho is a horrible place to live. You don't want to move here, and a lot of people have to live in a place for them to get a professional sports team. Actually, if they do get one, it would be in Boise, and I'm okay. Live on that side of the state.
that reminds me of when I was in Jackson a few years ago. I saw a shirt that said Jackson Hole sucks.
Yeah.
Tell all your
Tell
friends.
all your friends.
Tell everybody it sucks. I'm like,
It's
wait a
horrible
minute.
here.
Jackson Hole's pretty awesome. It's horrible. Don't come.
Yeah. Well,
I
I'm
know you
interested to
come.
hear, speaking of Jackson Hole, I know a lot of these people that you spent the last weekend with, or the middle of last week with at this conference, a lot of them we have first met in Jackson Hole, is
Yeah.
where we started meeting them. And we met the Global Interdependence Center and a lot of these central bankers, a lot of these policymakers had originally met in Jackson Hole. And then we've expanded our relationship over the years. And yeah, you spent the week with them, a lot of central bankers.
Yeah.
Very interested to hear some of your outtakes of what your opinions on what came from that meeting. So,
So last week I attended the College of Central Bankers, which is um, a sub organization within the Global Interdependence Center, also known as the GIC. So the CCB is the College of Central Bankers. Global Interdependence Center is an organization that fosters interdependence among different organizations and countries and central banks. And part of what they do is facilitate a lot of communication and with policymakers. Greg and I are very fortunate that we're able to attend some of these conferences and know some of these people who are very key and influential in terms of staying on top of where things are going. Actually, some of these people are the ones who are making these decisions. And we're very fortunate that we could be able to take that information and bring it to you. I always say I want to drink the purest water that I can. So you need to be close to the source and being able to you know, actually talk with somebody who's making decisions, actually voting on policy. or affecting those in leadership. So we go to these meetings so that we can bring this information back to our communities. And there's times when I watch CNBC or Bloomberg and I listen to somebody say something like that guy. Have you ever met you probably even never even talked to somebody on the Fed, and you're here telling us what the Fed thinks. But we actually get to go to some of these things. So last week at this College of Central Bankers, which was in Manhattan, there was a 2-day event. The first day was for only for it was a really private roundtable discussion, which is intended only for the central bankers. There are 30 people in that meeting that operates under Chatham House rules. So Chatham House rules, we can talk about sort of the tone and the concepts, but we can't attribute anything to anybody specifically. But there were 30 people in the meeting. 23 of them were former central bankers from around the globe. 13 of them were Federal Reserve current or former members. So governors and presidents that I get to hang out with for a couple days. And a lot of those people were still speaking. And there was other people speaking as well. But there are really 6 different themes that came up last week. And I wanted to share those with our community here. Let's see if I can advance the slides here. So the first theme was fiscal dominance and higher rates for longer. And so what do I mean by that? Well, I guess let me just start off that there is a really cautious picture that was painted among attendees and speakers that we're in a world with higher deficits, higher real rates. We've got AI-driven investment booms, political friction, and growing uncertainty around policy. And on the public, the word was cautious and diplomatic, but the off mic, behind the scenes conversations conveyed a very simple truth. And that is that markets need to prepare for a regime that's more volatile, less linear, and more forgiving than the past decade. This is not your father's central bank. Things have changed. And I think that there's some opportunities. We'll talk about some specific equities maybe on how you could trade these things. So the first concept that came up was this fiscal dominance, and that higher for longer isn't just a slogan. Structural deficits and rising interest expense limit the flexibility in monetary policy. The deficit is starting to impact. We talk about fiscal policy and monetary policy, and that there should be a very firm line between the two of those. And we have a president right now who's calling for the Fed to cut rates. And what he's looking at, of course, is our deficits and the fact that we're paying trillions of dollars. Well, we have trillions of dollars of debt. I think our annual servicing is $1 trillion. And everybody knows there's a debt problem. And you could go back 50 years and find headlines that talk about that we have a debt and deficit problem. And it's the same headlines. But the question is, when does it start to affect things? I mean, is it, Greg, are you concerned about debt and deficit?
Very much so. It's a longer term concern because it really talks about it has implications in the devaluation of the dollar, in the devaluation of all currencies, because it's not just the United States we're talking about either. In fact, arguably, it's not even the U.S. is not the worst country or group of countries. We're talking about this fiscal problem. The implications, though, just as an example, that I think are being painted with this fiscal dominance, is it's somewhat taking the impact of what the Federal Reserve can do, or any central bank for that matter, to control long-term interest rates. I mean, just look at our current cycle. We started cutting rates this year, in April? I think was the first rate cut, and we didn't cut much during the summer, and then we've cut again recently. I think the long-term bond, the 30-year bond, was around 4.1 or 4.2 at that time. We're at like 4.8 now, even though we've been cutting rates.
Right.
The 30-year bond is rising, and that's this story of deficits, this story of a decreasing value of the dollar, which is again pushing inflation up. I know we're going to get to that, but yeah, it's a concern long term, and does create, like you said, more volatility in the equities markets that the Fed can't really have as much of an impact as they have in the past.
Yeah, we're not going to see rates go back to this zero bond era that we had from 2010 to 2020. It's just not going to happen. You know, how does this affect different equities? I mean, I think, you know, the names that are on the top of the list will still be on the top of the list next year. Your Teslas, your Palantirs, NVIDIA and Apple equities are all good trades, but maybe also introducing some financial quality like JPM and Berkshire Hathaway, even though they've got some transitions going on there with leadership. And then, of course, we could, you know, on equities like that, I think trades that you would want to consider. Still think bullish trades on Palantir and NVIDIA are not a bad idea, but I think you want to be limiting your risk and considering defined risk spread trades, those bull calls or bull puts, trades like that, rather than just long stock, because the volatility is going to be there. And if the things pull back with a defined risk trade, you can, or a limited risk trade, I think all trades have defined risk, but except for a naked call that has no defined risk. A strategies, I would avoid naked put strategies. I'd want to be using spread trades here so that you can limit your risk in case those do pull back, and having very clear secondary exits of what you're going to do when the volatility does emerge. I think it's going to be particularly good for collar trades and covered calls. I think Apple reaches the top of my list as far as equities that I want to trade, and that theme will come up again. I think Apple is high quality name for a number of different reasons. I think will, you know, maintain in the forefront of a lot of traders' minds over the next year for sure. But for hedging, you know, the TLT, the 20-year Treasury ETF is a very, very liquid ETF, something to keep your eye on and potentially trade as a potential hedge. Would you consider like other hedges on ETFs, Greg?
Well, I think you can use again just broader put spreads on hedges like the or on ETFs like the SPY or the Qs or even the Russell if you wanted to put that on the IWM. You know, but when we're talking about big picture, I think the SPY fits the best. I wouldn't say go buy puts on the SPY because that can be expensive and timing is really important there. I think a way to lower your risk and still protect some of your portfolio of these names you're talking about, the Apples and the you know the big financials like Berkshire Hathaway or maybe JP Morgan that are good quality names. You could use put spreads on the SPY as a way to hedge that. So I think that's an interesting trade next year. I just want to throw one more comment on when you're talking about this idea of interest rate sensitive stocks that, you know, if we're going to have higher rates, I think it's important to add in a component in your fundamental analysis of looking at an individual company's debt exposure as well. I think you're right. That's why I do like companies like Tesla and Palantir and NVIDIA and Apple. And I maybe would shy away from maybe a Oracle as an example that's got a lot bigger debt exposure on a you know debt to equity standpoint than say Apple does.
Yeah, that's interesting. For some reason, Oracle's come up like it feels like sometimes there's I don't know, either the universe is talking to you or somebody's out there marketing. Like Oracle's come up a few times in the past week just different things I read. So I wonder what's going on there. But yeah, anyways, thanks for pointing that out. I probably need to dive back into the due diligence there and specifically take a closer look at the debt. So the second issue, a lot of discussion around AI, and there's, you know, we are in the beginning of a capital super cycle. You know, this is um, not just a meme stock or um, this is real. This what is happening in AI expenditure. And Lael Brainerd, she spoke publicly, so I can bring that up. And our friend Mike McKee actually interviewed her and did a great job. And she spoke, you know, basically made it clear that this AI thing is real, and we're going to see huge implications. And she was, you know, I guess you'd say bullish or you know, I don't know about optimistic is the right word, but the implications of AI and what it's going to have on the economy, which are both bullish and bearish, or positive and negative. That she expects to see productivity improvements that are going to affect not just the companies that are benefiting from AI, and that I mean like the NVIDIAs or the companies that are building AI, but the users of AI. In fact, I saw a report yesterday from Goldman Sachs on AI adoption, and it's the rate at which it's growing is pretty significant, and the value that companies get. I can tell you that my use of AI has is I can't imagine going backwards now. I don't know what I'd do without it, and it definitely makes me more productive. And I was talking to one of our clients, somebody we know this morning, and he's saying that he's able to do a ton of research in just a short amount of time and has come up with some phenomenal trade ideas. There's a biomedical company that got bought out this morning, and when he brought it up to me, the stock was up 159%, and he mentioned it to me a few weeks ago, and ChatGPT helped him identify that trade. So I think that's just one example of how it affects us, but the implications, and it's only going to get better from where it is here. And so those names that are going to continue to benefit, it's not just the NVIDIAs, but Microsoft and Google and Palantir, but also other enterprise companies like Snowflake, symbol Snow, are going to do well because it's data centers, it's the networking, it's the equipment, it's power infrastructure. We keep hearing about the US doesn't have the electricity. We see, I mean, I know electricity prices have gone up like 30% over the past year for some places, all due to data centers. So there's real opportunity at the different levels throughout the whole life cycle or the whole supply chain of AI. I think some interesting ETFs like the SMH or the SOXX, IGV, or even the XLK, the technology ETFs, might be a broad way to play this. Or you could look at some of the grid, the companies that I worked in the power industry, so looking at NextEra is one of my favorite companies on there. Um, Dominion, who's right in the heart of where all the growth is. I got to hang out with Jeff Lacker. I've met Jeff in the past. He's a really nice guy. Jeff is right there, and he's the former Fed president from Richmond, and he's Virginia is the epicenter for data centers. They just can't build enough of them, and so Dominion is the utility that's there, and certainly is going to benefit from it. But maybe Honeywell or even XLI.
Can I make a point on this as well? So I 100% agree with this AI trend. And I don't, the reason, one of the main reasons why I think the bubble isn't completely inflated yet is I think the biggest names have not even gone public yet. I mean, you look at OpenAI as an example of a
Right.
company that could go public. I think Elon Musk could decide to take XAI public. I think Anthropic is another big name that's out there that is very widely used. I took some notes on this. I'm going to go through them. So Anduril is another big a SpaceX, Perplexity, Stripe, Databricks, Kraken, Canva. I mean, Ripple. There's just a huge number of names that I think are huge valuation ideas that are tied to AI that have not even decided to go public yet, which I think they will. And so I think there's going to be still a lot of capital chasing those. Um, I think that if I can guess to what the downside of what they were talking about with AI is the fear that the job loss is going to be faster than they're replaced and the negative potential economic impact it could have on individuals. Did they talk about that at all?
Yeah, that Lael brought that up exactly. That this is a double-edged sword, and that it could have positive and negative effects. So the adoption of AI, not just looking at the capital spend that's going to happen, but the companies that are going to adopt AI are ostensibly going to need fewer workers to do the same amount of work, and so then
That's what
that could
increased productivity means, right?
right,
It's
yeah,
either
sure,
doing more work with less people or the same amount of work with less people. That's increased productivity.
yeah, right, yep. So who do you like in this space for investment? Or do you have any trading ideas?
I've always liked Palantir. It got ahead of itself. Their earnings will catch up, I believe. I still think they're really, really expensive. If I had to pick, and I know I sound like a bandwagon guy on this, but if I had to pick two companies, NVIDIA and Tesla, I think are two of the best AI
Yeah,
companies you can buy right now.
right. Yeah. And you're gonna see lots of volatility. Nvidia's up 2.5% today. There was some announcement about China taking their 400 trips, not the Blackwells or the 200 trips. I don't know, whichever. Um,
I
but
mean, I still like Micron too. Micron isn't necessarily AI, but it is AI build out and it is memory still. And all these data centers require memory to be part of their build out. So
they have earnings coming up this week, don't they?
they
Is it this
do.
or next week?
Next week, I think.
Okay.
Maybe it is this week.
Yeah. Earnings is coming up soon here, I know. And I think it is next week.
17th. Yeah, next
Yeah,
week.
I did a nice little bullish trade on them that's doing really well today, and it expires before earnings. So yeah, I had a bull put going on them. So I still would implore people to consider defined risk trades. I think interesting trades on some of these um, bull calls or call diagonals or call calendars might actually work. And another name that I sort of hinted at these uh, secondary sort of ways to play, like through the utilities or the industrial companies like Honeywell. Another good name that I think belongs in there is Freeport-McMoRan. That's my AI play, right? I mean, they're a miner, but they mine copper, and everything we're talking about here involves copper. So I like Freeport-McMoRan. It's been a holding of mine for a while. It has been volatile. They had a mine issue with some tragedies there, but they're getting over that. I think copper is a leading indicator of the economy, and I think we're seeing where copper goes. I'm bullish on it. Here's a big one that's a real concern is that the growth of private credit. And you remember when we were in Jackson Hole with Waller? He asked everybody around the table, like, what are you worried about? What are you thinking about? And it was really awesome to see that he's asking those questions. And most of the issues that he came up that people brought up, debt and things like that, he was able to say, those are known. We understand those. I know his concern at the time was this growth in private credit. And what we're seeing is a huge amount of lending that's happening now outside of traditional banks. So private credit structures are harder. So the banks, they're all part of the Federal Reserve. And one of the reasons why you don't tend to see volatile moves in Bank of America or JP Morgan or any of these big banks is because they report data so frequently. And there's some data that they report weekly. And so we're able to see that data and get a pulse. It's one of those companies that those companies tend not to have big moves around earnings. They do move a little bit around earnings, but they're not like a Netflix that'll make a 20% move on earnings
Well,
or a
and again, a
10% move.
lot of that is a result of the great financial crisis, right? I mean,
Right.
a lot
Yeah.
of the rules and laws that were put into place following those bubbles have helped stabilize these still arguably too big to fail institutions, but they're they don't have that big of volatility anymore because of these laws.
Well, this is one of the things that came up in this meeting is that there's not a lot of insight into these private credit vehicles that are out there. And, if there's cracks in the system, it's not something that could have major impacts, but we're not going to see it. And the Fed also, this is another reason why we're talking about the limits of monetary policy now and how much monetary policy can affect. So if there's institutions out there that are loaning money that are not borrowing from the Fed, they're not as affected, and maybe indirectly they're affected by the Fed rates. Um, in different ways, we can think of how they might be affected, but not directly impacted. Which the Fed is trying to drive stimulation and cutting rates, and if a lot of people now or a lot of companies are using these other vehicles to fund themselves, they may not be able to get the kind of stimulus that they want. I don't know. Have you ever looked at any of these credit ETFs? Have you ever traded anything like HYG or
I
Jump?
was going to say I've looked at HYG. I look at it more as an indicator for um, high yield bonds. That's typically an ETF that tracks high yield corporate bonds. And JNK, of course, is the other one. I've never actually traded either one of them um, because it's not a space I look at other than more as an indicator. And um, but I think you could for sure. I would rather trade, again, using them as an indicator, I'd rather trade a sector or even an individual company of what they might represent. Again, you have high risk, junk bonds typically more associated with smaller cap companies. So if you see either one of those, credit risk issues rising, a better trade, from my opinion, might be to place maybe a put spread on the IWM on the Russell 2000,
Yeah,
because they're most likely going to be the ones that are impacted the greatest.
right. Well, I think it might make sense if this is a concern, and it is a concern of mine, to really take a look at the fundamentals. And we preach at Options Animal the importance of looking at fundamentals and looking at companies, specifically screening for strong balance sheets. And companies that will make their way to the top of the list would include Microsoft or Apple or Berkshire Hathaway. What else would be on the top of your list? Do you have any ideas or thoughts on that?
Again, I would put companies like JP Morgan on the top of that list. I'd put Google there.
Mhm.
Google's another name that I'm not worried about their balance sheet in any way. Um,
And those companies, when there is a liquidity crisis, they tend to do well. So, yeah, we could have pullbacks in certain sectors of the market, but those companies tend to do well when we have that sort of issue. So another big one that came up was just the dollar dynamics and the political undercurrents that are going on. So there was a discussion with two former central bankers, or actually one current central banker from the Bank of England. Catherine Mann spoke, and another central banker from the EU talked about the dollar dominance, and they went through the story of the sterling and how the sterling, which was the previous reserve currency of the world, the UK currency, the British currency, lost its position slowly. That in fact, there's this slowly and then suddenly. Is there a Hemingway quote or something like that? I think that was,
I think it's Hemingway. I think you're right.
yeah, something like
Slowly
that.
and then all at once.
Yeah, and then all at once. And that's the way that it happened. But it was something that, that you could paint the story. Catherine Mann sort of stepped through a 100-year history of the things that happened. And we're heading down that path right now with the US dollar. It is the dominant currency for sure, but geopolitical instability, trade friction, policy divergence create, cyclical volatility, and it does undermine the current reserve currency. And I don't, I have some friends who are Bitcoin maxis, and they're like, fine, great. We have exorbitant privilege. That was the term that was used by a French central banker as referring to the United States, saying that whoever has the reserve currency has exorbitant privilege. And we are able to have lower rates, and the reason why we're able to have the supremacy of the U.S. dollar is because of this reserve currency, and it will be a very painful transition. Now, of course, the question is, what is it going to be? Could it be the euro? It's not. It's definitely not going to be the Chinese renminbi. Nobody's going to move to China. There's the BRICS out there. So the British, Russian, Britain, Russia, no, Brazil, Russia, India, and
India and
China
China.
that are trying to come up with one currency. And maybe among those four countries, they would trust it. But I can't imagine anybody else, um, trusting.
See, and I'm still of the opinion that this whole concept is never going to happen. Never is a really strong word, I know, but one difference amongst all the references in the history that you can point to, going back to the Roman Empire and ancient Greece and the British pound, and we have such a different distribution of capital now than we did in all of those scenarios. We were geographically limited to the ability for those currencies to have global movement in a microsecond right now. And there are dollars around the entire globe. And if we had a collapse of the dollar and some move somewhere else, it's going to collapse the entire globe. And I still agree with you. It's like, what else is there? Bitcoin, maybe. And maybe the Bitcoin maxis are the ones who are ultimately right when that does happen. But I think that's a global chaos situation that I don't buy into that one. Could you see a slow weakening of the dollar and eventual maybe some sharing, maybe another global currency shares maybe, but that's a long, long play. I think I'm long gone before then.
Well, I think the outcome for traders to start paying attention to is FX volatility, which
Yeah.
affects the income of multinational companies like an Apple, a Tesla, or Microsoft. That these are things that can swing in both direction, and there are ways to play them directly. You can trade currencies, but if you wanted to add an ETF without getting into the FX market, you could trade FX, and Brett Donnelly would be more than happy to teach you how to do that. But UUP, FXE, or FXY are all ETFs that allow you to get currency exposure. Um, and which way is it going to go? I don't know that am smart enough to tell you whether to be bullish or bearish on those. So maybe straddles or strangles are the way to play those. They tend to have low implied volatility. So when we do get outsized moves, the volatility spikes up and that helps out. Or maybe
I
even
think the way
gold.
to hedge it, sorry to interrupt. I think the way to hedge it's with precious metals
Gold.
or with crypto, either one, or maybe both. Whether it's gold or silver. Silver's been one of the hot movers this calendar year. But I think if you're worried about things like that, I have some crypto in my portfolio. I have gold and silver in my portfolio. So for me, it's just a hedge against that potential risk. But I'd be cautious trying to trade based on it because man, it's a long play in my opinion.
Well, the fifth theme that came up, and there's only six here, folks, so we're wrapping up. But love to get people's feedback on what they think here. But this is a big one that I know that's near and dear to, well, probably to a lot of our hearts, I guess, and that is central bank independence. And, there's, I had some sidebar discussions about, who do you think will be, who do you think should be the next Fed? And the odds market have Hassett and Bessett like way ahead, and then Warsh in third place. And then you've got Waller and Bowman in distant fourth and fifth. I can tell you universally that everybody that I spoke to on all sides of the aisle here supports Waller. I think anybody other than a Waller would be a big mistake personally. In terms of what the Fed needs to do, the Fed needs to maintain its independence. And this goes back to the stuff that we talked about earlier in terms of the reserve currency of the dollar. Part of the reason why we have the reserve currency is the trust that we're going to do the right thing with monetary policy. And if you put a markets guy in there or a trading guy in there who doesn't, I understand the desire to get rates down. We want rates lower. And I know the concern, of course, is that it helps with our debt, but that's Congress needs to get its act together and do its job. It's responsible. Congress and the House and the presidency are responsible for fiscal policy, and the easiest way to fix it is to just cut rates. That's monetary policy, but that comes with a downside. And the risk, of course, is inflation. The reason you cut rates is to raise inflation. And looking at the latest data, I was reading Kobesi letter. I don't know if you saw his tweets. Like he's got this list of, superlatives of, all, 2% from all-time highs and GDP's up. I mean, everything is great. Why are we cutting? And inflation's going up. Why are we cutting rates? Inflation has stopped going down. I think this is a scary thing, that really could have major implications if we put the wrong person in charge of the Fed. Um,
I couldn't agree more. I mean, I wish they would bring Jim Bullard out of retirement and put him as the Fed chair. I would take Bullard. I would love Chris Waller too. I mean, obviously you and I know him. He would handle the job. Having a trader in there, you're right. I think is probably the wrong move. It needs to be someone who can hold the government accountable for their, going back to your first concept that they talked about there, and that is that fiscal dominance.
I
Um,
listened to where I read something that Trump had said about, or maybe I heard it again. He said it, and I don't know if I read it or heard him speak about rates. And the words that he was using was, um, made me wonder, does he really understand what monetary policy is? I mean, it was kind of scary because it sounded like what he was talking about is other countries that have lower rates than us. And, he's a finance guy, right? So he definitely understands rates. I mean, everything he does in terms of development requires bonds and requires borrowing money. And whoever has the highest quality, I mean, whoever's the lowest risk should have the lowest rates. And that's what he was basically saying in the speech, is that we're the lowest risk country. Why would Pakistan have lower rates than us? That is not the purpose of monetary policy. It's not like you have good credit, so you should get a better rate. That's basically what he was implying. And I just wonder if does he really not understand monetary policy? And I mean, I'm sure, I know that at least 50% of our people listening right now are saying he has no clue, right? And that may be true. Um, but don't underestimate your enemy. That's a big mistake. So don't. Is he that? Does he not understand?
I'm going to pass on
You're gonna
that.
pass. Okay. Well, I think we're going to see more volatility. I'm telling you that if we put the wrong person in that office, we're going to see a lot more volatility. We're going to see the VIX. We're going to think 20 is low for the VIX. That does not mean you should trade the VIX, folks. You could trade other things. The VIX is based on SPX options, so buy SPX options and watch them go up in price. The VIX, by the way, just as a side note, I made a comment that you can't trade a VIX calendar, and somebody called me on it. They're like, "What do you mean you can't trade a VIX calendar? I can do a calendar on my broker platform." Like, no, you're not actually, you can't trade the VIX options. They don't exist. Like, but no, I see them in my broker platform. Like, those are not VIX options. Well, it says VIX. And they have expirations. Those are VIX future options. Each one is a different future. You're trading an option. It's like buying a call on Coke and selling a call on Pepsi. They usually move together, but not always. And you know that there's massive losses that happen to people who don't fully understand the implications of the VIX. So never ever do a calendar on the VIX. You are naked one option. You're naked long and naked short on two different equities, basically. So, anyways, how do you trade the VIX? I mean, no, we'll leave that to another topic, but I'm not suggesting that people go out and trade the VIX, but I think we might see it go up. But the good thing for that is that means all option prices go up. And so, I know you and I both don't mind higher volatility because it means higher premium for the options.
Yeah, I don't mind higher volatility, but you're exactly right. You've got to understand how to trade it. People, and in some cases, still the need to buy puts even when the VIX is high. I think that's another thing people shy away from is they think, especially when they're looking at collar trades and the price of protecting an equity, and they look at the VIX and talk themselves out of actually buying puts, when it absolutely is telling you you need to buy puts right now. Even though the premium's high, the hurricane's right there. Go buy
Right.
your hurricane insurance.
Right. Yeah. Yeah. the reason option puts are expensive is because you need them. That's one of my mantras. But listen, next year is an election year, right? So it's an off-cycle election year, but we've got, we're going to have a lot of these things that are going to impact. We also have a potential government shutdown coming in January again. We just kicked the can down the road. So another government shutdown. These are things that are going to impact volatility. So
Yep.
I still think you're safe playing, to me, the companies you want to own are these big cap, um, well-known companies. Apple, Microsoft, Google, NVIDIA work their way to the top of their list. Um, as a hedge, this puts on the SPY or puts on the Qs or something like that. And of course, the collar trade is always a great strategy to use anyways, because you can make money in any direction depending on how you structure it. The final thing that came up was this concern over tariffs, right? So protectionism, which by the way now is bipartisan. So we have both sides of Congress supporting this um, protectionism, and exceptionalism of the United States. It doesn't bode well. There's a huge international contingent that was at this meeting, so it didn't bode well for them seeing it. They, I guess they understand it, but and then tariffs. I mean, tariffs are essentially a tax. They cause higher input cost and they caused inflation to go up. I mean, I guess I see arguments on both sides of this, but I think I'm settled on the tariffs cause inflation. You, Greg?
I what's really interesting is, you and I have brought this up several times over the past couple of years, this double hump of inflation, and everyone has forgotten that, and everyone has written it off that, oh, this is not like the 70s. Man, the charts are identical right now still, and we are in the trough in between those two double humps and just getting ready to take off again. The projection would be for inflation to take off again in 2026, and we could potentially see inflation go from 3% up to, if we hit the same numbers, we're going to see 14% inflation in 2027 if we
Nine.
follow the
I'm,
same
I'm
pattern
going
that we did in
eight
the
or
70s.
nine. I don't think 14, 8 or 9, but you're right. And do you know the reason for the second hump? Every time, so we've had three cycles before in the past, three double hump cycles of inflation. That looks like a double hump camel. And we've got one right now. So we're right in the middle of the trough. They lay right on top of each other. It's
Yep.
uncanny how they look. The reason for the second hump is always one thing.
A
It's
policy mistake.
a policy mistake by the central bank.
Yep.
And I think putting Bassett or Hassett or Warsh in as chairman and
And cutting
starting
rates right now would
cutting
be a
rates
mistake.
would be a policy mistake.
Yep.
The market will probably love it, but then inflation takes off, and do we want another cycle like that? I don't know. I'm not, I'm not an economist, but but I did stay at a Holiday Inn Express once, so I think, there are beneficiaries here, the reshoring companies. So XLI, which is the industrial ETF, is a broad way to play this. Caterpillar, Deere, Honeywell, I think are names that will benefit from more reshoring. So do some more due diligence in that space. Eat Tesla. If we, have tariffs on cars that are built EVs outside, Tesla could do well. And then the companies that have pricing power. So probably even your Dollar Trees and all those other Walmart, Costco, some of these retailers, discount retailers, could be equities you'd want to have in your portfolio. So that was basically the gist of it. I do think that there's opportunity here in the chaos. So I think this is one of the reasons. I think we're going to come up on a year where option traders are going to excel because we understand how to manage risk and have secondary exits when things don't go our way, as opposed to, the traditional buy and hold sort of trader. I think the next year or two, um, we do have to watch out what happens in the election. Typically, that second year, is it the second year of the presidency? It's
Yeah,
doesn't
it usually does well.
does well. Third year, not so well though.
Right.
So
And we'll see. I mean, I agree with you, Eric. I think the biggest takeaway after, hearing your summary, is that it's really important to understand how to manage risk. Because what you don't want to do, when you hear some of these fears about inflation and central bank policy volatility and independence and hidden leverage in the private credit scenarios, when you see those, you don't want to go run to cash and say, I shouldn't be invested right now, because you're going to potentially miss out on one of the biggest runs that we're going to see in some of these AI names. Yes, we've already had big runs, but I don't think it's over. And like I said, I think a lot of the big AI names haven't even gone public yet. If you look at the biggest winner from the internet bubble, or maybe one of the top two winners, you can maybe say Amazon's the biggest winner right now. But maybe the second biggest is Google. It didn't even go public until after the bubble had burst, like a long time. Like it didn't go public until like what, 2005? That was a long time after the bubble burst, yet Google is one of the biggest winners because it hadn't gone public yet. And I think, like I said, Anthropic and SpaceX and some of these names that are still sitting in private hands right now that are huge opportunities when we get to trade them, you don't want to be hiding in cash and gold, missing the opportunity that the market's going to give you right now. But you still have to recognize that we are going to have volatility. And so to me, the collar trade is absolutely the name of the game for the next couple of years.
Yeah. Well, I was going to review some of the equities that we mentioned here, but it'll be in the transcript or in the description down below. So traders, take a look through that list and go through and see if you see anything that's not on your watch list and maybe add it to your watch list. I'm not suggesting you run out and buy those companies, but look for opportunities to get in some of those high quality names that we mentioned here. There's some great companies and some ETFs, I think, that you could see doing quite well if you know how to put the strategies together around them and how to get them. Anything else, Greg?
No, I think that was awesome. I'm sad I didn't get to go with you. Next
Yeah,
time.
this is the meeting was very well received. The people who attended came away with a lot of, wow, this was really good. Let's do it again. So yeah, certainly the audience that was there, these are the people that are, that when you read the news, these are the people that you're talking to. They are decision makers and key influencers that were there. So, anyways, I hope this was useful to you. Appreciate love to hear your feedback on this, and hopefully we see you in another show or another event soon.
Thanks, everybody.